How did leverage impact the derivatives market origins? Imagine controlling a large amount of something with just a small amount of money. That's what leverage allowed traders and investors to do in the early days of derivatives. It played a big role in shaping how these markets grew from simple ideas into complex financial tools. Derivatives are contracts whose value depends on an underlying asset like crops, stocks, or currencies. When traders used leverage, they could enter contracts that were worth much more than the money they actually put down as margin or collateral. This meant they could take bigger positions without owning the actual asset. Long ago, around 1750 BCE in ancient Mesopotamia, farmers and traders used written agreements to buy or sell goods in the future. These early contracts helped manage risks like price changes. While they didn't explicitly use leverage, they committed to future transactions with limited upfront resources. This set the stage for later ideas of controlling larger positions with less capital. In medieval Europe, merchants started using contracts similar to today's forward and options agreements. These allowed traders to share risks with financiers, reducing the amount of money needed to undertake large trades. This sharing of risk was a form of leverage that supported long-distance trade and economic growth. The real turning point came in the 1800s with the creation of the Chicago Board of Trade. They introduced standardized futures contracts for commodities like wheat and corn. Traders only needed to deposit a margin, usually a small percentage of the total contract value, to control large quantities of goods. This use of leverage made trading more accessible and increased market activity. Leverage also helped transform simple commodity contracts into a wide range of financial derivatives. It allowed investors to take large speculative positions or hedge against risks like price swings in commodities, interest rates, or currencies. This ability to control more with less capital made derivatives more popular and expanded their use across different markets. However, leverage also meant that losses could be magnified just as gains could be. This risk of big losses led to regulations aimed at controlling how much leverage could be used to prevent market crashes or instability. In the end, leverage was a key factor in the early growth of derivatives markets. It allowed participants to take bigger positions, transfer risks more efficiently, and help markets become more liquid and dynamic. Without leverage, the complex and broad derivatives markets we see today would not have developed as quickly or extensively.